Welcome back to Real Estate Mindset. Good morning. We're happy to be here for another live video, and we plan on doing lots of Q&As. Firstly, though, to Les Hahn, he's asking, Travis, how do we apply math on Valentine's Day? And I will first of all say I appreciate you bringing up the word math, Les. But here's the thing, brother. If you're worried about spending money, remember what Valentine's is about. Society would tell us it's about buying flowers and chocolates and cards and spending hundreds of dollars on movies. But I'm here to tell you, brother, remember, it's about quality time. So how does the math work? Put a zero next to the expense that you plan on spending on Valentine's Day and buy some gold and silver. Well, I'm not a financial advisor. But either way, you guys, happy Friday. Happy Valentine's Day. Good morning to everyone. There's Volvo. John, I appreciate you. There's Sid. Where's I Am? I saw I Am a little bit earlier. There's I Am. We got a lot to talk about today, guys. I'm really looking forward to it. David, Danny, Daydreaming. Man, it's nice to see you guys. I'm so happy it's Friday. It has been a brutal work week. We are so close to rolling out our real estate school. So happy. I hope you guys are going to join us. I hope you're going to become a member of that school. Not only are we going to have courses and newsletters, but we're also going to be doing weekly seminars and weekly trainings. So one-on-one potentially, if no one signs up, but I hope you guys join. We're putting a lot of work into this. I've been working on this for the last year and a half. You guys know that. So we'll get started. But before I do, Mitch, good morning. How are you?
Good. It's a rather brisk morning outside, but let's get going here.
Look at how much these people love you. Buffalo Blanco, morning, Mitch. Hope you're doing well. Buffalo, where's my love? I'm jealous. I'm so jealous right now. Mitch, I love you, man. All right. There's P. Mitch. Good morning to Joe as well. Tom, really appreciate all you guys. Let's get started on our first video. We're going to go right into a video today, and we're going to listen to a talking head. Yes, it is going to be a talking head. And the fact that CPI and PPI came out hot kind of is an indicator that there's no reason to cut interest rates. So this video is going to go into the fact that there is no reason to cut interest rates. And it's also going to talk a little bit about how, according to this video, President Trump wants interest rates lower and to go hand in hand with tariffs. So that may be a bad thing, maybe a good thing. Either way, hope you guys enjoy this video. And please let me know that the audio is okay. And we'll get started right now.
The president has also been pushing for lower interest rates, saying they should go hand in hand with tariffs. But our next guest says it's not the time to cut. The Fed should keep rates on hold, she says. We've got good growth, healthy labor markets, sticky inflation. Loretta Mester is here with us. She's the former Cleveland Fed president, currently adjunct professor of finance at Wharton School of Business and a CMC contributor. It's great to see you. Welcome.
Thank you very much for having me.
So the big development this week, CPI, is that why we're on hold? And it was interesting to have the president say lower rates should go hand in hand with tariffs, when, if anything, tariffs probably make lower rates less likely, or maybe they don't.
Yeah, I mean, the CPI was just another confirmation that the progress on inflation coming down has stalled since the fall of last year. And so, given that the economy still is healthy in terms of the labor market and growth, we saw that the economy grew at 2.5% last year. That's really good. It was 3% the year before. That's very healthy growth. It's above trend, right? There's no reason for the Fed to be moving rates down at this point. They need to hold and wait and see how things develop. And so that, it was another confirmation that we haven't seen the progress that we'd like to see on inflation. It doesn't mean that inflation won't start to move down later this year. No, you can't say that yet. We saw higher inflation numbers at the beginning of last year as well, and then inflation began moving back down. But I would say at this point, there's no compelling reason to cut rates, and holding this seems to be the best play here.
Should they have cut rates? I mean, they did cut rates by 1% last year.
Yeah, I mean, the rates were very high and very restrictive at that point, and we had seen a lot of progress on inflation, so they were bringing them down. Now, it's debatable how restrictive the current interest rates are, but I would say most economists say they're still somewhat restrictive, and we'll have to just hold here for a while to see what's coming. Well, there's a lot of uncertainty, as we've talked about, coming out of the...
Well, the bond, as you know, Laura, the bond market, listen, the Fed's done what they've done. Right. So what do you always say? You get what you get, and you don't get upset. Don't get upset. Well, the bond market got upset.
Yeah. Well, the bond market is reacting to a lot of things, right? The bond market yields went up partly because they were more euphoric about what was the outcome for growth coming. Right, so there was a real play. There was a term premium in there, worried about the deficit, right? And then there was what the Fed was doing. So I don't think you can point to the Fed as being driving that 10-year
The weird thing,
Treasury market.
I don't know if we have this chart ready, but it would be a chart of monthly job growth over the past 12 months. And it just this eerie thing happened where job growth started to slow throughout the summer. We had that yen carry trade things, setting markets lower in August. And it looked like the economy's rolling over, the markets are rolling over, and that's why they cut 50. Okay, fine. Then immediately jobs started to pick up again. And so those facts change. And I'm trying to figure out, if you're the Fed, what do you do about that? I mean, this is such an unusual cycle.
Well, you do know that when the data comes in, that they can be revised. And so that's why the Fed always says, look, we don't move on one data point. We're going to look at what the data is telling us. And you're exactly right. I think the reason they started cutting in September was because, right, they hadn't made all that progress in inflation. The size of the cut, whether 25 versus 50, I think was driven by their concerns about some of that, what was going in the labor market and some of those reports. Now, you're right, that got revised away.
Well, it's still
but the labor market,
but then it picked up again.
Yeah, but it is a moderation from what we saw, earlier last year in terms of the growth rate in employment. So I would say that it's still a healthy labor market. It's still, in balance, supply and demand, which is what you want. You don't want overly tight labor markets or, overly loose labor markets. So it's an imbalance, but that's something that they're going to be looking at going forward, partly because of the uncertainty around what some of the forthcoming policies will be. They're going to have to be very attuned to that.
You're an Ohioan. Where are you from originally?
There's a lot there when at the same time, Mitch, there's nothing there. So real quick, I got some questions. I want to throw them up from the viewers. She made some comments. I like she's just looked into the camera. She's like, we use multiple data sets because the data is going to be revised. Oh, okay. The data is going to be revised. And she's also like, we cut interest rates 1 full percent because they were very high and we made progress on inflation. That came out of her mouth, Mitch. She said rates were very high and we made progress on inflation. But actually, historically, the rates weren't very high at all. They were average. And what progress at all has she made on inflation? But do you agree with her that the labor market is strong? Or do you think the labor market may be toxic and we may not have the job loss that some of us thought we would have by now as a result of the PPP and the EIDL from lockdowns? Do you remember all that billions of dollars that was injected into small businesses? What are your thoughts on that video?
3 parrots without the benefit of intellect. Everything that was just said there is complete nonsense. So most economists was one of her quotes. Okay. Most economists. Perfect. What economists? That's the people you stick on a spreadsheet and you say, these are the idiots that need to be fired because there's simply no truth in any of this. So it's real simple. It comes down to the federal debt. The interest rates, the higher the interest rates, the higher the payments on the federal debt. That's all that President Trump is looking at. Real simple. All this other crap about, well, these payments were injected in this amount of unemployment. These things don't even belong in the same sentence. You have to pull them apart and figure out what's the cost of the underlying issues. So, and inflation, really? Go and look at eggs. So they say, well, eggs are a problem of bird flu. Right? We had to destroy so many birds, and now we don't have them. That's inflation, right? It's supply and demand. It's inflation. All that matters, aside from the median household income, is the cost on the federal debt. What creates the federal debt? The Federal Reserve. So these people have just got blank for brains.
Yeah, I agree. And we're going to go over some probably, I don't know. I'm only going to go over maybe like 10 charts, but I have a whole bunch of updated charts to go into. But she just said it herself. The data is just going to be revised anyway. So the data is being used to continue to get us to spend from what it sounds like. This is a super chat. Thank you, sir. Albino, Gen X here, unemployed truck driver, can't find work. I'm sorry to hear that, brother. I know that's hard, but don't give up. Keep looking. The labor market's not balanced. Tired of these boomers messing around with everything. They messed up everything for Gen X, millennials, and Gen Z. And I got to tell you, sir, man, I know it feels that way, right? Because it is that way. But what I have been doing over the last year and a half, 2 years, is I've been trying to redefine my life. And I've been trying to redefine what I want from life and redefine how I'm investing and redefine my expectations as I'm waiting out for some type of balance to come back. But I wanted to tell you, man, don't be discouraged. This is just a time in life that's hard. Luckily, tomorrow's a new day. And I just wanted to say, man, you're not alone. All right, you're not alone. A lot of people are suffering. I have 4 children. So when I'm suffering and I can't save money, it really brings me a lot of anxiety and stress because no one's going to take care of my kids but me. And my kids' education costs 25% of my income, brother. I know how hard it is. Hang in there, keep doing good, join our community, right? You don't have to pay for it. Just join our community and talk and understand you're not alone. I really appreciate your support. You didn't have to do that, man. You're unemployed and you gave us $10. I appreciate that, man. Thank you so much. Mitch, excuse me, a couple things. I really appreciate that. I mean, he's unemployed. He donated us $10. That's really appreciated, man. I got a couple comments. We'll be fast right here because I want to go into a market update. The 10-year is absolutely sinking right now. Some of the CNBC segments yesterday were hammering that inflation isn't coming down, so the Fed needs to raise interest rates. Mitch, do you think the Fed needs to raise interest rates right now?
I think the Fed needs to be shut down. I think the doors of the Federal Reserve need to be chained. And I think CNBC, for all the damage that they've done to the economy by virtue of being complicit in all the lies and the propaganda, should have its license to broadcast revoked.
Okay, tell me how you really feel, buddy. All right, and I got another kind of a flip-flop here. Thanks for the great info. I appreciate that. Will Powell and the Fed cut rates if Trump stops government hiring and keeps firing, since all jobs in the last 4 years have been in government. Let me ask this a different way. If Trump stops government hiring and that leads to recession, okay, so recession, will then Powell cut interest rates? What do you think, Mitch?
My only question is, can President Trump turn Jerome Powell into a useful idiot to do what is necessary to be done? Like I said, he may be a very nice guy, but the bottom line is he's completely useless. The Federal Reserve is completely useless. We've already stated it's a 50-50 coin flip as to what action they're going to take based on whatever it is that they want to claim is in their documents. And then they're going to turn around and revise it anyway. So there's no edge in having the Federal Reserve. The market should be determining the interest rates. The biggest problem and why those interest rates need to come down immediately is because every dime that is being paid for inflation, in other words, the federal debt, every dime that has to pay to cover that off is the interest rates. So if you eliminate major chunks of this debt, i.e. the fraud, then your interest rates will automatically come down. All these things are connected. So it has to be done. Jerome Powell's an attorney. He doesn't know jack about anything. This guy, like most attorneys, probably can't add 1 and 1. It's a useless proposition. They really need to take a strong stand here. You want these interest rates to come down? Get rid of the fraud. Get rid of the Federal Reserve.
In other words, so here's the thing. Here's what I think. I mean, I think Jerome Powell is chomping at the bit to lower interest rates since he cares about the banks, not the Americans. And I do think that if we go into recession, for sure, he's going to cut interest rates. I mean, they're already cutting interest rates. We're not even in a technical keyword recession. This is a comment. Assessors did their drive-by shootings last week. What John Doe is referring to is the assessment values for our property taxes are essentially out now. And that's why we've been going crazy on these new courses and this new membership in this new school. Part of my seminars that I'm going to be teaching is how to protest property taxes with comparables. I'll also be teaching on credit income assets. And I'm also going to be teaching on how to do comparable market analysis. So I'll be helping existing homeowners, future homeowners, and potentially investors or realtors or really anyone that wants to know how to do the math, how to use the math to find a great deal versus emotion. So, my God, I'm really excited on that. All of that to say right here, let's go to this comment. And first of all, the gangster bankster, I like that. It rhymes. Is that the pillow guy? Dude, the pillow guy's on here, brother. I appreciate the $5 in support, man. Appreciate the pillows, everything you're doing, man. I love those pillows. At what stage is Mitch's, I'm just joking, by the way. I really appreciate you and happy Friday and happy Valentine's Day. At what stage is Mitch's lawsuit in Texas? Now, here's the thing. and I want you to answer this, Mitch, but I wanted to say this. There are many faucets to what Mitch and I, especially Mitch, is doing in regards to eliminating property taxes permanently. It's not just the one lawsuit that he has. We've also been working with members of the House. We've been working with other politicians, mayors, constituents. We've been doing so much behind the scenes. It's more than just that lawsuit. The next thing that we're about to roll out, and again, it's going to coincide with the school that we're opening, is actually Mitch made. Listen, guys, this is crazy. When I saw this body of work of Mitch's, I mean, gave me goosebumps. Legitimately, he's made a criminal complaint template. He's literally, Mitch Vexler has made a criminal complaint template for you guys to review, to complete, to send out, so that you guys can help us fight the fraud. So we'll be going over that. Really excited about that. Mitch, do you want to add anything else before we move on to what is the stage of your lawsuit in Texas in regards to property taxes?
So we just found out yesterday that the brief is due to the Fort Worth Court of Appeals, not oral arguments, and that's fine. But we should be in front of that court final brief within the next 40 days. And at which point we suspect that they're just simply going to say, fine, kick it back to the original court. Over and above that, I literally am in the process right now of rewriting another amicus brief to hand over to President Trump and Elon Musk. There is a bill that Helen Kerwin is working in the state of Texas to go through the House Ways and Means Committee based on an amicus brief. So I wrote that amicus brief, then I wrote that bill, and now I'm rewriting an amicus brief to hand off to President Trump because somebody is actually having a meeting with him next week. So I will deliver that to them probably tomorrow morning. So there's an awful lot of stuff that's going on under the hood. And I just found out about that literally an hour ago. So we're working and we're hammering away very quickly.
Yeah, I mean, I did a round trip to Dallas in the same day just to talk to Helen. I mean, you guys, this is really important to us. Obviously, I have to survive. I have 4 children, so I need some help. That's one of the reasons why I'm doing the school. But nevertheless, man, I mean, I'm out here dying, just trying to complement everything that Mitch is doing and then make my own change. I got something for you right here from P Nice. I love my P Nice, man. This is my buddy. I hope we can meet one day, P Nice. I look at you like as Jeff and Johnny. Really appreciate all your support. What he's saying, though, Mitch, is he's like, Mitch is a bulldog, but this is what I want to say, P Nice. He's our bulldog, though. He's our bulldog. Thank you for being here, Mitch. You're our bulldog. Don't go nowhere. Don't you go nowhere, Mitch. All right.
Yeah.
Enough of that. We'll go back to,
as part of that criminal complaint that we'll be posting shortly, attached to that is an open memo to the DOJ, the FBI, the SEC, and we're literally laying the groundwork for criminal complaints against the school superintendents, against the chief appraisers, against the co-conspirators, against the boards. We're literally laying it out. And we're going to set these documents up so that regardless of what district you are in the United States, you can literally take that template, fill in what suits your particular circumstances, and then go and file that with the police and or your local district attorney. This is what is necessary in order to move this forward, because these people need to be prosecuted. And once these criminal complaints are entering the system, the police, the DAs, and the judges no longer have any choice, but they must adhere to the law. And if they don't, those are the judges you impeach. So this sets the groundwork and puts all that in play.
I'm excited about it. I'll be honest. Real quick, and I want to go on to our next segment here. This is a comment from P Nice. I wanted to clear this up. You get Travis's courses for free. Support his work. Like the video, subscribe, and become a member for $1 a month. P Nice, do not become a member of the channel for $1 a month. The courses that we have are for free, but what we're doing, P Nice, is I'm enhancing everything that I'm doing, and I'm going to charge some type of membership. I don't know how much yet, but everything that I've been doing for the last 6 months has been an enhancement to all of the courses I've already worked on. And really, it's going to be more of training and teaching and seminars. The courses are additional courses are going to come with the membership, but it's more of a situation to where we want to create an actual school and a classroom, and that way we can communicate individually for weeks on end and grow together. So I got to be able to afford to do that, unfortunately. So anyways, I appreciate you, P Nice. Let's go on to the next thing. There's my buddy Austin, by the way. Wait till Doge gets into the Fed and IRS. It's going to be insane. I miss you, brother. I got your messages. I wish you would have come out to the Hurricane Helene with me. That's all right, though. All right, let's go on to the market right now. We're going to do a market update. I just got to change the timestamp real quick, Mitch. And then we will get started. And we're going to start right here with that 10-year Treasury plummeting. So it stayed bound. I mean, as always, right? Some piece of news comes out that 10-year in the morning either explodes up or explodes down, but it hasn't been going under 4%. And interest rates for residential mortgages have been elevated about 7%. The reason why, and you guys should know by now, this is important because this is what consumers care about, because this is what's impacting residential mortgages. The federal funds rate, which is the rate that the Fed is cutting, does not directly, it could influence, but it does not directly impact residential mortgage rates, okay? The long end of the yield does, which is the 10-year. So what this is showing is there should be a decline in interest rates slightly a little bit later today. Moving on to the market, geez. So the market is completely flipped right now, and it's sideways. So pretty much the whole market's sideways, it looks like. Looks like gold is absolutely insane. I think silver potentially has hit a new high as well. Here's CME Fed Watch, guys. Now, the expectations for the Federal Reserve to cut rates has been shifted essentially from September now to July. Unfortunately, the market's useless. This is not going to really help us. This is more, I look at this as a reaction to what's going on in the market, because this is always wrong. They're not going to cut interest rates, or at least they should not cut interest rates, at least in a meaningful way for consumers, until we have a recession. Why would they cut rates unless we're in a recession? It wouldn't make sense. They're fighting inflation. If they cut rates, it could add to inflation. So they should only cut rates when we do enter recession. But nevertheless, the market is super confused and essentially starting to price out any rate cuts this year. Also, what's very interesting, and I'm surprised that this hasn't been talked about more, is how ungrounded inflation expectations is becoming. The 5-year break-even inflation rate is absolutely out of control right now, sitting at 2.64%. So the market is basically calling out the Fed and saying, you're useless. Even 5 years from now, your inflation rate is not going to be 2%. It's going to be 2.64%. So that's not good. That means inflation is going to be sticking around for a lot longer. And we see that because we see the money not being emptied from the reverse repo market. If we were in a situation where there's credit tightening, even I would say true quantitative tightening, we wouldn't see this excess money just staying in the reverse repo market. This means that these banks legitimately are maxed out. They still have a ton of money, but regardless, this has $67 billion in the reverse repo market. A little bit of a depressing update right here. Now, Doge has saved, I think, $37 billion, but the debt has increased $308 billion year over year. So not good. Now, obviously, fiscal year started in October, but the total deficit right now for 4 months, $839 billion. That's 58% higher than last year, and last year was the 3rd highest deficit in our country's history. And we're exceeding that. And you guys, here's the thing I want you to really, really wrap your mind around. They're doing this, and we're not even in a technical recession. They only should be doing this to save us. But instead of saving us right now, they're getting the bubble bigger and bigger and bigger to the point where it's going to create a depression. At least that's a possibility. So regardless, absolutely out of control. Take a look at this as well. This is freaking crazy. This is the Treasury General Account. And what I'm trying to show you guys is these rich elites and these government agencies, they got all our money. They literally, they still have the money. It's we, mom and pop, that don't have money and are suffering. But look at this Treasury General Account at $809 billion. So why are they trying to raise the federal budget? Exactly. Can't we just use this $809 billion right here? Isn't that our money? Yeah, it is. And not only that, oh my God, look at this. This is mortgage-backed securities held by the Federal Reserve. So they're sitting at $2.2 trillion in mortgage-backed securities. So tell me, how do they not own Fannie Mae and Freddie Mac? If they own this much in mortgage-backed securities, and Fannie Mae and Freddie Mac is government sponsored, then how is the Fed not Fannie Mae and Freddie Mac? They're 100% Fannie Mae and Freddie Mac. And all they're doing is just this kabuki theater, because this is not doing anything. Look at how they still got 2.2 trillion. So they're saying they're doing quantitative tightening. But we still got 2.2 trillion. We've been doing this for what, guys? Almost 3 years of quantitative tightening. And inflation's what? Is getting worse again? After 3 years of quantitative tightening. That's how much fraud's in the system. So I think that yeah. What do you want to look at?
Go back 2 charts.
Right here?
To the deficit. Yeah. Because what you just showed on that other chart, I want to make a point here. The gross domestic product which is what we touched on yesterday, is roughly $24 trillion. To reduce just $2 trillion of debt would mean that that gross domestic product of 24 trillion would have to go up to roughly 51 trillion. So what I missed yesterday, and I had the opportunity, but due to the time we didn't get into it, was this issue of M0, M1, and M2 and M3, which the federal government doesn't consider M3 anymore. That's the amount of money in circulation. Well, if you look at what Travis is now showing on the national debt at 850 trillion, we just got off of 1.8 trillion in deficit. So that 839 billion is on its way to 1.8 trillion plus in deficit, meaning no money to pay for it. Well, the issue with the M0 is the amount of money that is printed, handed off to a bank, and the banks turn around and they buy US treasuries with that money. Could be denoted as accounting fraud, but yeah, it gets worse in that if somebody has US treasuries, a bank, pick the bank, Citibank, and they're holding US treasuries and they say, well, but we can use these US treasuries as an asset and we can lever this asset into mortgage-backed securities. This is the point I've been hammering on with regard to paper chasing paper. There's no asset there. Those mortgage-backed securities, you cannot, because they've been cut 1,000 ways. They take a bucket of mortgages and they slice them up and say, here's a tranche of mortgages. You can't get to the underlying asset. It's the definition of paper chasing paper. The question becomes, how much of that paper chasing paper is the Federal Reserve covering off? And that's the point that I've been trying to get to. We just didn't have the time yesterday, but I just want to make that point crystal clear that if you've used the US treasuries and levered into really bad nuclear toxic waste product with no underlying asset, yeah, you've pretty well committed fraud.
Well, come on, Mitch. I mean, everyone's committing fraud, at least at the lenders. Here's an interesting comment. This is from our buddy Coors Light 2025. Stop drinking Coors Light. Stop drinking. Start jogging. Mitch made a point about cutting the rate means less interest paid on the debt. I'm going to review that comment later to make sure I understand. So, I mean, do you want to respond to Coors Light quickly, Mitch, so we can move on?
All debt has an interest rate on it. The problem that President Trump recognizes, because as a business person, you understand, I got a mortgage, I got to pay that rate of return on that mortgage. If the Federal Reserve creates more debt, the natural recourse in the marketplace, more debt means higher interest rates. Why? Because there's higher risk associated with more debt. And this is the point that is now affecting mom and pop, because there is no money to pay for this, even at a personal level. Mom and pop's level on a house, we know that the only thing separating 37% of the population from bankruptcy is $9,000. And out of that $9,000, $7,000 is real estate tax. A person earning, a family earning 80,000 is literally 20,000 a year, give or take, upside down. Money they don't have, which is why the credit card is exploding. It's why the payday checks are exploding. People are levering themselves to try and stay afloat of this. And that will explode. There's no way out. The second you go and take one of these bad situations and lever up, there's no way. You're delaying the inevitable. It's bad. Well, that's at the mom and pop level. But the thing is, the math is the exact same thing at the federal level. That's why they ended up with 1.8 trillion in deficit. They don't have the money. They don't have the ability to go and increase their income, gross domestic product, by $25 trillion to get more money to pay that off. They're at the exact same point. There's no separation between what the Federal Reserve is doing and what is happening to mom and pop. They're directly correlated. The money isn't there. And they can't print their way out of it, because if they print their way out of it, you end up with the Weimar Republic. And when you get the Weimar Republic, that is exactly what happened. The interest rates ballooned out of sight. It took a bucket, a wheelbarrow, literally a wheelbarrow full of money to go and buy bread. That is what happens when you print.
Right.
And that's why I keep hammering the table. You've got to get rid of the fraud in the system, and you've got to do it now, because there's no money left to be had.
Yeah, and I don't think that bread was that good. I mean, if it was a special bread, then maybe, but I don't think it was no special bread. This is an interesting comment. I'm going to get back to this here in a minute because we got to move on to our next segment. But this is good, Austin. I will get back to that. I don't know, Silver Bullet. Have you seen that movie? I remember, this is funny. I pulled this up when my oldest son was like, I think he was like 6 years old. He got into our computer, went on YouTube. I think it was YouTube, and he watched that movie Silver Bullet, and it freaked him out. It's about a werewolf. Have you seen Silver Bullet? Anyways, let's see. There's another thing here that I wanted to comment about. Oh, Nikki, where have you been? It's nice to see you. Nikki has been here from the very beginning. Look at, see, Austin. Everyone knows P-Nice, Dean, everyone. I mean, we're just a crew hanging out. Let's go into our next video at 30 minutes, and this one is on how exactly what we've been saying, how the Federal Reserve is not going to do anything essentially until we're in recession. And if for the viewers, can you guys let me know that the audio is okay? I'd appreciate that. Mitch, I'm going to mute you, not because you're the smartest person I know, but just because I don't want to hear that echo. That didn't make any sense. All right. I hope you guys enjoy.
Joining us this morning here at Post 9, Morgan Stanley Wealth Management's Chief Economic Strategist and Global Head of Thematic and Macro Investing, Ellen Zentner's with us. It's great to see you. Welcome in.
Good to see you, yeah.
Why do you think people were willing to take the optimistic view yesterday and then the feed through to PCE relatively well today?
Yeah, well, I think, the CPI is about 2/3 of the PCE index. So you have a pretty good handle. PPI has to really surprise in certain key areas of financial services and healthcare in order to really move the needle on what you're thinking about PCE. And actually, our economists had 0.4% estimate for core PCE after yesterday's CPI data. And then with the PPI data that feeds into that today, they brought it down closer to around 0.3. It's still too high. Doesn't really matter. This January data, we already know that some of the governors are looking through these early months just because there tends to be some seasonal residual bias. Economists love that term. And some other, you've got the California wildfire effects that are lifting inflation in some areas. So it's just a muddy picture. Right. And it doesn't really change the narrative that Powell has been so focused on, which is there's no need for us to do anything here. So I think unless the labor market just falls apart, there's really nothing for the Fed to do.
Is there any evidence of cracks in the labor market?
Not really. Not really.
Some people are looking at the work week.
Well, I'll tell you what I don't like. I don't like that there's no churn. And it's not just in the labor market. People aren't moving and shaking. They're not leaving jobs and getting other jobs. They're just staying put. Because it doesn't show a lot of confidence in getting another job after you are separated from employment. But there's also no churn in the housing market. There's just not a whole lot of churn at all in the economy. We're just kind of holding steady.
Isn't that part of the lock-in from housing and the lack of mobility?
Yeah, I think it's all wrapped up together. And I think it's the age of the labor market and where we are. It can't get a whole lot tighter. And people, we've got heightened uncertainty in this environment. And just heightened uncertainty for households and businesses. You don't want to make a lot of big decisions. And so, but yeah, the work week is not continuing to expand. And so that makes you think, well, the next move then would be shrinking the work week. Also, the initial jobless claims, though, are still very, very low. No broad-based layoffs.
So which do you think causes them to react first? Lower inflation or higher unemployment?
Well, I think lower inflation can certainly get the Fed thinking, okay, we do still have maybe a little bit more to go toward neutral. Chair Powell did describe the current stance as restrictive. I think there's a lot of folks on the FOMC that question, though, whether it's really restrictive right now. And you do have a big divide of opinions. And when you have that big divide of opinions among voters on the FOMC, it creates policy paralysis. You just don't feel confident to make a move. And there's not any data that's really slapping you across the face to make a move. So I think if inflation does come down in the next
median household income,
it could prompt them to say, okay, we do still believe that a cut is likely this year, a cut or two, and we see that in their March projections. But certainly if the unemployment rate starts moving higher quickly, and you would see that initial jobless claims as well, then the end is near for the labor market. And so you do need to start moving.
We did take note this week of various trade uncertainty indices close to record highs. We saw NFIB CapEx intentions. Do you think that's the beginning of something new?
Well, I think it's you go back to 2018, 2019, and when the trade disputes were really rising and creating a lot of angst, it also had a big sentiment effect. I think the difference that we're seeing right now that we're waiting for is that there was a clear feed through to economic activity in 2019. We were approaching a global recession, and that is why the Fed moved toward the sidelines and started to cut. And their transcripts show that clearly, including their words describing that time. This time, we've been getting slapped around hot and heavy with executive orders, this possible tariff, that possible tariff, reciprocal tariffs. But we've been through this. We've been through this before, and we survived it then. And so the idea is, can we survive it now? Not all executive orders have been put in place. Not all tariff threats have gone through. So we're seeing the impact on sentiment, but we're not sure yet how much of that is going to feed through to economic activity.
Maybe just not enough time has gone by yet. And, probably because of things like PPP. Remember that? The Payroll Protection Program, and the EIDL, the Economic Injury Disaster Loans that they just threw into banks. So I got some questions. Oh my God, you guys had your comments are absolute fire. You guys in the comment section. I don't know if you guys are reading these live comments, but you guys are smart. I really hope that we can learn together. I think this school is going to be so great. I'm so excited about this. 2 years, about a year and a half, 2 years in work. This is from Coors Light. Coors Light made it on the podcast again. Now it's crystal clear why Americans need support finding the fraud. We must put pressure on the courts to allow Doge auditing. And that's the thing. And the fact that it's got so political, it's really drives me crazy because, and I'm just going to speak for myself here, politics divide people. And the other thing is if there's no fraud, then they have nothing to worry about. It's as simple as that. So it doesn't have to do with being a Republican or Democrat or whatever your race is. It's fraud, is fraud, is fraud. And that's it. So a good point, Course. I got some stuff here for you, Mitch. I got some stuff here. You look pumped up, man. You look pumped. Let me see. Hold on one second. I just want to throw this comment. This is from Buffalo Blanco. That means white buffalo, I believe. Wife told me Mitch is live. Had to hop on. He's telling facts. Thank you, Buffalo. I feel this small right now. Avoiding buying in Dallas Fort Worth area with high prices on new construction. Okay, so they're thanking you. You're in their area. Do away with property taxes. Just got my senior citizen exemption denial. I've had enough of these taxes. I mean, case in point, I'm sorry you're going through that, Tom. Man, so they got their homestead exemption. Tom, fight your property taxes. The property tax course is free. I made 40 freaking chapters and made a free form to show you guys how to fight property taxes. I'm also going to fight my own property taxes to show you guys how I do that. I'm going to be walking in the ARB. That's not, let's see here. There's one thing I want to give you. Here's this from Austin right here. Can't yet. Circuit judge stopped JP and Fed from turning over even CVS to Doge data for an audit. You can't audit without that. Appeal court, strike it. Mitch, do you want to comment on that? Not getting political. If we ever get, I don't want to ever talk politics, man. I hate talking politics. It's not a political channel, but I mean, it's just people are so sensitive when we need to be united, not divided. But what do you think about here? You think that they're stopping Doge on purpose to keep the fraud going? What are your thoughts on that?
Anybody who stands in the way of detecting fraud is in fact themselves the problem. And that goes right to the judges. I'm sorry, but if you're a judge and you do not allow this fraud to be discovered, you need to be impeached. You will be impeached. This is coming your way shortly. The truth of the matter is that every stitch of this fraud must be eliminated for this economy to get back on an even playing field for mom and pop. I want to go back for a second. So that economist from Morgan Stanley says, well, the economy seems stable. There's no turn. I'm concerned about there's no turn. The key word is not no turn. The key word is stagflation. Why do you have stagflation? It's because the Federal Reserve is monkeying with the interest rates and nobody can afford to sell a house. A, prices are coming down. B, interest rates are going up. It's all backwards. And it all comes back to the fraud. So then she shows her bias at the very tail end of that clip. Well, we've been slapped around by these tariffs. He is the problem. Again, another parrot without the benefit of intellect. It's all about the fraud. The fraud is what is creating the interest rates, right? The fraud is what's creating at the school district level money that mom and pop don't have to the tune of $250,000 per household that has to be paid off over the next 30 years. Ergo, these school districts, the ones that are really big criminals, you got small criminals and big criminals, go after the big criminals, put them into bankruptcy, put the superintendents in jail. Why? Accounting fraud, bond fraud. And we're about to come out with an entire list of that. And that's what's going to be below one of the videos in the next couple of days as soon as it gets released.
Les, Han, I got a couple comments real quick. With all the fraud, math isn't adding up. Emotions are all we have left that we can trust. No, no, Les, you haven't been listening. No, that is not true, Les. Don't use your emotions. You don't want to use your emotions. You want to stay clear of your emotions and you want to use math. The thing is their inputs are fraud. So that's why the math isn't adding up. You just got to look at different areas of math and do your own math. And that's why I keep trying to take you guys to comparable data. So we don't have to look at all this other fraud and we can figure out what's really going on. But don't use your emotions, Les. Real quick, from Panda, you're using too many big words for Travis. Don't move. We talked about this, brother. Dumb it down a little bit for me, brother. Thank you, Panda, for warning him. I miss you, Panda. It's nice to see you. And look, here's Nikki. She's right. I didn't have my monster this morning. The more monster that I drink, the more that I'll understand big words. I love you guys so much. Mitch, you were going to say something.
Yeah. Travis said the idea of looking at the comparisons, right? So his course shows people how to deal with the comparisons. I wanted to take that up one step. Because we are now in fraud season, i.e. tax appraisal season, when you go to your ARB, your appraisal review board, or board of evaluation, just depending what state you're in, same thing, go and take somebody with you. These are public meetings, and have that somebody video record and audio record that meeting, because you will be able to use that in court. So in other words, Travis will show you through his course how to get the true comparisons. And those are the true comparisons that you want to show to that ARB panel. The CAD, the Central Appraisal District, does not have the unilateral right under law to determine what is the true comparisons. You get the true comparisons. You say, no, these are the true comparisons. These are why. We've set up underneath all these videos the documents that show which part of USPAP will be violated if they don't do it. And then you've got the audio recording on top of that. So now at a minimum, should you decide to go with your neighbors, 1, 2, 3, or 4 neighbors, and say, that's it, we're going to file suit against these CADs, we're going to file suit against the chief appraiser. You've got several people in your neighborhood that are in the same position. You've got it on audio, you've got it on video, and you've got the true comps. At some point, you're going to win. Why? Because they're clearly violating the laws. They're caught. And that's the reason why we've got the template coming up momentarily that says, that's it. We'll file criminal complaints against these people, because if the ARB is going to be ignored and the judges are going to block it, start filing criminal complaints, because when a judge blocks a criminal complaint, now you've got recourse against the judges to throw them off the bench and have them impeached.
Well said, sir. Man, we got so many good comments. I'm not going to be able to get to all of them in time before moving on to our next segment. Really appreciate the super chat. They're saying buy precious metals. I may buy some silver. I'm not giving financial advice, but I may buy some silver. I really appreciate your support. We're going to move on now to consumer debt. I got a lot of charts to show you guys. And then again, towards the end here, we'll go back into the questions, because you guys have some just outstanding questions. Right now, let me remove this. Now, take a look at this. This is pretty heavy right here. There's a lot of information in this update. This is household debt and credit. This was released in February, so this was released this month. This is a quarterly report. This is a Center for Microeconomic Data, and there's a few charts. And by the way, you guys, there's like 40 charts here. So if you want to come back and you want to look at this in more detail, go ahead and do that. I'm going to just flip to some important things and some points that I wanted to talk about and make here, starting with this, the total balance and its composition. So I just wanted to remind everyone that, and this is why that income is so important, like median income is important, because, mom and pop have to service this debt. This is how much debt that households have right now. Obviously, mortgages have absolutely exploded. Everything has absolutely exploded. Student loan debt, credit card debt, it's all higher for the most part. Minus like HELOCs. HELOCs are lower than the GFC, but my point is that is a lot of debt right now that American households are in. And if we can't pay this debt that you guys are seeing on your screen, then that will lead to bank collapses, and it will lead to recession, which will lead to job loss. And then once the recession happens, After the recession happens, that's when you start seeing deflationary things, right? Like house prices and things like that. But another thing I wanted to point out, you guys, is how crazy this is, because take a look at this. And we'll go over the inflation here in a second. And I just showed you. So we have all these, recessionary indicators, mom and pop suffering, but there's so much inflation that the elites are still maintaining. And on top of that, people can still spend. Look at this, guys. So what this is saying is the people's credit line compared to the balance on their credit cards. So in other words, how much money do people have left to charge? First of all, credit card debt is horrible, but right now, okay, the credit card debt is this light blue. Credit card balances, the amount that people can charge is up to $5 trillion. The amount of the balances is slightly, it's like 1.2 trillion. So that means that there's another $3.8 trillion in credit lines that people could max out. So my point is, don't max out your credit card. It may feel like it's a good idea because look at what you see right here, but it's not a good idea. Things always change, but my God, people can still spend money right now until there's credit tightening. And I've been talking about credit tightening forever. This is bad. This is why we need credit tightening right here. How are you going to stop inflation with that much credit lines of credit? So anyways, I thought that was interesting. Let's go to page 15, which is percent of balances that are 90 days delinquent by loan type. So 90 days delinquent is kind of like you're done, right? That's like serious delinquency. You've pretty much given up. And what I want to point out right here is the credit cards, the trajectory in the credit cards. So there's a few things. The GFC's right here, okay, right where my arrow's at. So there's a few things that are in worse shape than the GFC. Mortgages, as far as delinquencies, are not one of them, but credit card debt, again, we have 1.2 trillion. I just showed you that. Credit card debt and delinquency is absolutely out of control. This is saying percentage of balances, that there is 11% of balances on credit cards that are 90 days, not 30 days, like, oh, I forgot to miss my payment. 90 days late. Look at the trajectory as well. That trajectory is absolutely incredible. The last time we had this trajectory of credit card delinquencies was going into the recession. So the fact that this trajectory is here with as much credit card debt that we have, and we haven't been in a technical recession, my question is what happens when we do go into a technical recession? Then what happens to this data? But the same thing with auto loans. You can see school loans are down, but school loans, we're going to start seeing a lot more delinquencies for school loans Q1 of 2025. Mark my words, because remember, they suspended late payments from hitting credits on school loans for, I don't know what, 2, 3, 4 years, something crazy like that. But take a look at that, guys. Credit card debt and auto loan debt, the trajectory is going up, and it's not good. And this is serious delinquency rate. But again, what's low is HELOCs, mortgages, and school loans. So that's very interesting as well. Let's go to page 18 so I can show you guys defaults after recession. Okay, right here. So I thought this was a good way to show you guys that delinquencies aren't always an indicator of an incoming recession. Typically, the defaults and delinquencies, the bankruptcies, the foreclosures, the price declines, that happens after we enter technical recession. And right now, we can't enter technical recession when they keep printing us out of one. We know they're printing us out of one because we can track the deficit spending. They are keeping us out of recession, and it's killing us even more. But again, these are not recession indicators. After recession happens, that's when the crap really hits the fan. You can see that right here when we look at 30 to 60-day late payments on mortgages. So again, it was still under where we're at right now. So it was about 1.4%. And right now we're at about a little less than 1%. But look at what happens after we go into recession. I mean, everything skyrockets, 30 to 60-day lates and 90-day lates after we go into recession. So the fact that this has been going up right here before recession, that's abnormal. And also look at this. When was the last time we had this upward trajectory? When was the last time? The GFC. Right before the GFC. Do you see that? So the trajectory is also important to keep your eyes on. Let's take and go to page 20 now. Okay, this is interesting as well. So page 20. This is what I wanted to show you guys. Here's the number of consumers with new foreclosures and bankruptcies. First of all, the data is conflicting. This is saying this is from the New York Fed Consumer Credit Panel. But when we look at things like HUD and the Census Bureau pulse surveys, it's saying that this is a lot worse. But what I wanted to point out is, again, this is bankruptcies and foreclosures. Unfortunately, some homeowners and some consumers still have a beating they can take. So I showed you guys the fact that people could still charge money. This is also indicating that people can still get crushed, and there's still a little bit of room for people to maneuver if we just looked at this data. But when we look at the leverage, when we look at how companies are at maximum capacity, if we look at PE ratios, payment to income ratios, mom and pops, balance sheet, the trajectory of data, it paints a true picture. But just looking at this data, this shows us that bankruptcies and foreclosures are historically low. So I wanted to make that a point. But again, I question the data that they're using. If it's Black Knight, then we know they're not using even half of the data. Now take a look at this, guys. Again, this is the transition into serious delinquency. This is by age group, but the reason I'm pulling this up is, again, to show you guys that things go delinquent after we go into recession. Okay, so after the recession happens, then really bad things happen. But right now there's all this political games and, oh, no, we're not going to recession. Everything is great, whatever. But what I want to also point out is the trajectory of delinquency, and this is serious delinquency, pretty much going up in every single group. And if you go back into the space-time continuum, the last time we had an upward trajectory, and correct me if I'm wrong here, was 2007. So almost 2 decades, 18 years. So it's been 18 years since we've had this type of trajectory. That means something. And then when we go to page 28, you can really see that here as well. Transition into serious delinquencies for mortgages by age. It doesn't start getting crazy, you guys, until America wakes up and starts getting like, oh my God, I just lost my job. But look at how it spikes into recession. So I'm really trying to hammer down here that these are not indicators of recession. Consumers get hurt generally after. Why? Job loss. But again, pointing out the trajectory of delinquency. The trajectory is going up. Last time we had an upward trajectory is literally 2007 going into the GFC. So although we're still under those levels, until they revise the data, we may have a little bit more room to go. Who knows what the data is going to show, though, a year from now. Transition into serious delinquencies for autos. Now, the thing with autos are showing that we're already in recession, as well as credit card debt. Autos right now, unlike mortgages and school loans, it's an absolute dumpster fire. Look at the trajectory for all age groups. And again, right now, the delinquency is worse than going into the recession. So we have a worst set of delinquency in auto loans and credit card loans than we did going into the global financial crisis. That should say something to you guys. Again, what am I talking about? The trajectory. Auto loan trajectory is absolutely out of control. Everything is skyrocketing when it comes to auto loan delinquencies, exceeding the delinquencies during the global financial crisis. What's going on in our economy right now is very confusing because of the inflation. Let me show you guys credit cards right here. Same thing with credit cards. Look at that. So I just showed you guys auto loans in worse shape than the global financial crisis. Here's credit cards that are in worse shape than the global financial crisis. And I just showed you guys we have way more debt that people are responsible for both credit cards and car loans. But look at that trajectory. Absolutely insane. The trajectory is absolutely incredible for delinquencies, and this is serious delinquency rate. Look, it didn't even start going up again until the global financial crisis. So the fact that all of these things are going up before a technical recession means probably that the government is messing with us, man. I mean, the government keeps playing around with our economy, and that's what happens. Let's see what's on 31. Same thing here, guys. Credit card delinquency by age. I mean, it is higher than it was before we went into the global financial crisis. Do y'all see this trajectory? So, this is not put in these Wall Street videos. And also what I wanted to show, again, making my point here, bankruptcies are also not a recessionary indicator. Bankruptcies, just like foreclosures, traditionally happen after recession. Again, you guys, it's not an indicator. We can clearly see that in 2005 when bankruptcies were exploding because we didn't go into recession. Okay, so the recession is going to make things worse, is the point I was trying to make. So be careful on what data you're looking at when really what we should be looking at, Mitch, and I'll say it for you. I already know what you're going to say. Median household income and whether or not mom and pop can afford this. But I thought you guys would like that. Before we go into our next video, did you want to comment on anything we just went over?
Yes. I want to address this idea of empirical evidence and the flaw of indicators. So if we look at all those charts, put them to the side for a second. Just yesterday, I received an email from a business owner in Denver. His business has been closed. He was in the recycling business. his building is bought and paid for. His problem is he doesn't have the cash on hand to pay for real estate taxes on a business that was closed because the inputs were no longer there, to pay for the tax on a building that's bought and paid for. That's empirical evidence. That's fact on the ground right now today. So in essence, go get the money or we'll take your asset that is bought and paid for. So what is that definition? That is the definition of RICO. Create a fraudulent valuation, a fraudulent debt, and hold a gun to somebody's head, which is pay me the money or we will take the asset. So all these indicators, charts, graphs, it's not the human level. Take it down to mom and pop's level. This is a guy that owns the building that doesn't have the money. By the way, he's 74 years old. He worked his life to pay this off, and now the threat is, we'll take your building. So that is the truth.
Right, and that's not in that data that we just went over, by the way.
Exactly.
And that's the point we're trying to make. Like, what the hell is going on with all this data? It's freaking crazy. A lot of stuff I've been watching is reversed as well for no explanation. Let's see. Let me put up some comments here real quick, Mitch. So this is from Clark. Healthy labor market where all I see is mass layoffs and several people around me have been laid off and can't find a job. They've been applying for 9 months thus far. Obviously, it depends what industry they're in, what sector they're in. But Clark, I really appreciate your intel. Intel is important, you guys, because that doesn't happen everywhere. And so it's important to get everyone's intel, right? So we don't want to get locked in some narrative just because we want to hear it. We don't want to be trapped in an echo chamber. So my point is communicate with each other. Here's something from Course Light. Mitch made my point about cutting the rates means less interest paid on the debt. Yes, I'm going to review who's coming. Yeah, we talked about that. How does the commercial real estate market conditions impact both the Fed and bank debt and the single family home markets? You want to answer that quickly, Mitch, and then we'll move on?
They're all linked. So I, as a developer, am a monkey in the middle. I'm only as good as my tenants can afford to pay rent. So rent goes to a commercial property. Doesn't matter whether it's multifamily or a retail property or an industrial property. Rent has to be paid. The problem is if the tenants can't pay it by virtue of their equity stripping, just like this case that we're talking about in Denver, if they can't pay it, then I, as the monkey in the middle, cannot pay my mortgage and the whole system collapses. And the reason I'm not building right now today is that exact issue. I cannot literally stand in front of my investors and say, yeah, let's go to construction and let's drop a $50 million multifamily project on the ground, knowing full well that if I do so, I will be targeted just like everybody else with real estate taxes that are completely fraudulent. I will be held up for extortion. It doesn't work. The math doesn't work. It's gotten so bad that a non-credit tenant just came through the other day for sale. And this is a small restaurant, 3,500 square feet, non-credit, good area, good location. And it's on the market for a 5% rate of return. But the value per square foot to the building is almost $400. And the truth of the matter is the building, if that tenant moves out, that building isn't worth $65, let alone $400. So when you look at these rate of returns, why would you do that when you can simply take your money and stick it in the bank, get it a CD at 4.75 or 5.25 and not have the downside risk? This is what the fraud has done to the system. It's inverted the economics to the point where I'm a guy who can employ an awful lot of people when I'm building. But the reality is I can't justify it because there's no clarity on the ability to get tenants to be able to pay the rent. So my cost today to build is $225,000 per unit for multifamily 3-story brick and stick. That amount of money would require $2,200 a month minimum to go and justify that. So if you go to 4-story, which is a more urban type product with a parking garage, well, that's $325,000. That would require $3,250 roughly per month to justify doing that. How many tenants do you know that can either pay $2,200 or $3,200 a month? Then you say, what's the credit risk profile to doing that. Well, the truth of the matter is, congratulations for those fools who went and built. The truth of the matter is you built product with 70% credit risk. That's what we are facing right now today, which is why I'm not building. I cannot do this in good conscience and say, yeah, let's just go and build. Yeah, I'll make money. But the truth of the matter is I'm making the money because I'm building it, not because the product will generate the profit. And I'm not about that. Everything we've always done, our track record is perfect. We've never blown a deal. No bank has ever lost money on us. And I intend to hold on to that, but I can't do that looking at what we're staring at today. I can't get the math to work. So until that math can work on multifamily, we sit tight. There's other things that can be done. We're looking at buying stuff, but the bottom line is, globally speaking, this is the problem of the fraud. You can't go and build something and have somebody hold a gun to your head saying, well, we're just going to go and increase the value this year because it's up 60%, it's up 100%, it's up 400% like they tried to do on my retail building. You can't do it. You can't make the math work. That's the problem.
I'm looking forward to going to seminars that Mitch is hopefully we're going to have here soon that analyzes these types of deals because I have a lot to learn as well. I got a question here from Trevor. I'll answer it. It's addressed to Mitch. I'm in Katy, Texas, which is right down the way, actually. After the crash, should I buy a home 100% PMNT? I think that's I don't know what that means. Buy a home 100% payment or cash. This is vet tax exempt up to a $510,000 home. So what they're saying is they're disabled veteran and they're not going to have any property taxes. Thank God for that. At least Texas takes care of veterans in that way, 100% disabled. But the thing is, Trevor, you have to be able to define what is a crash. Like, what is a crash to you? A crash to me just means that I can find my dream home at an affordable price. And so the important thing here, Trevor, is whether it's before or after the crash, understand what a great deal even is. And the way you do that is just you use simple math. You use comparable data from the subdivision of the property, wherever the property is located, and you use those comparables to figure out, does this property have wedge? Is it really being purchased under market value? Can this property cash flow? Now, I have a free class you can take. You can go to any of my videos, go to the description, and click step 2 where it says get educated, and I have a free class for you, and it will go over those exact things. And I talk about VA loans and mortgages in that class. Now, once I have the school, you can bring that question to the school and show me the property, especially because I'm in Houston, and we can actually analyze that together. And that's what I'm trying to bring to the table when I finally have the school up. Great question. I know you asked it twice. That's why I put that up there. Now,
I got one comment on that,
here. Yeah, go ahead.
So, Trevor, understand something. In the last 5 years, the central appraisal districts have fraudulently overvalued the real estate up in 5 years, over 100%. So if you just simply look at it and say, well, I could afford it 5 years ago, but I can't afford it now, that's the proof that that 100% increase in value has got to drop back 50% just to get you in a position where you were 5 years ago. That's the fraud in the system. That's what we're looking at. So if you say my household income is X and my debt to income shouldn't exceed 28%, there's a high probability you're going to be right back to where the value should have been 5 years ago today. In other words, you've got to look at something where you can sustain yourself moving forward and not get into trouble. If you pay at today's prices, we've proven that there's literally no difference right now today in buying versus renting. The American dream is dead. The American dream of home ownership is dead. The only way to get it back is to revert the prices to where they were 5 years ago to justify, yes, it makes much more sense to own a house. It makes much more sense to be able to have an amortization schedule. But right now, that's not there. Don't get into trouble.
And also educate yourself so you know what getting in trouble means, right? That's really what I'm trying to explain too. Like if I found a house right now, Mitch, that was 50% under market value and I like the house, I'm buying it right now. I'm buying it right now, but I know what to expect. I know how the math works. I have proper expectations. I'm not letting someone cheerleading me in off of a cliff of financial suicide. This is from TA Chapman. TA, thank you for the support, brother. Thank you for the $10 super chat. What they're asking is have you, Travis and Mitch, considered a media blitz to get more eyes, maybe Trump, on this property tax thing? I'm always talking to Mitch about that. I think I think that you should. I talked to Mitch about that. it's been hard, and I'll let you respond, Mitch, but it's been hard because we've also been doing a lot of behind the scenes work. I mean, literally just hours every single day. As soon as we stop recording, it's back to work. It's putting classes together. It's figuring out how to conquer apathy. It's talking to officials, talking to attorneys, talking to, oh my God, political reps. I mean, it's just one thing after the other. But I definitely, in my opinion, I definitely think that a push should be made, especially once we get that school up. And I think we should go on every single media or channel and keep talking about property taxes. I think we have a real strong possibility of eliminating this as long as there's enough people who support removing it. And I think, I don't remember the comment is, someone was like, disappointed that we're trying to remove property taxes because they're like, well, the renters will pay it, the renters will pay it. And what Mitch and I are really desperately trying to explain to you guys is that's not necessarily true at all because of the way that property taxes work. Property taxes are in everything and passed along to the renter already. So hopefully it would cause rents to go down, not up. But either way, I appreciate your comments. So we have, go ahead, Mitch, what response to that? Yeah, go ahead.
So TA, here's the issue. We as a community and this Travis's channel has to rely on everybody that's out there moving these videos forward, posting on X, posting on True Social, posting on Rumble. We're two people, and the amount of time that we spend getting this package, people don't understand how difficult it is to get these videos going. We're doing this live and off the cuff, but the amount of data that's in the background, like the amicus brief, to write that amicus brief takes weeks. So that's all I would focus on in those efforts. We have to depend on mom and pop to push this forward because in my particular case, I'm not on any social media. I mean, it was Travis that reached out and then all of a sudden this thing took off, but it's difficult because I'm not on social media and Travis is focused on YouTube. So we rely on the good judgment of mom and pop to help push this along. We rely on Helen Kerwin, the state rep, to help push this along. Everybody we come in contact with, or the people who interviewed me, like George Gammon or Dr. Chris Martinson, anybody who's interviewed me, they're pushing this along because they understand how bad this situation is and they want to take an active role. But I need mom and pop, everybody that's out there, to do the same, take an active role and push this.
Yeah, and honestly, the school and the teaching and the seminars is going to help us do that because some people are like, Mitch, where do we do next? And so if we have a platform for people to go to continue to sharpen their skills and continue to stay united to do these things, it's going to help even more. A couple things real quick. Luke, what is a timestamp? That's a chapter. So when you come back here, everything will be chaptered. Adam, I know you've been talking a lot, man, stirring people up. I appreciate you commenting. I will say that to everyone. I appreciate the freedom of speech. Oh my goodness. Government, especially Trump, not Biden. I hate politics, man. You see what I mean? Like Adam's probably a cool guy. Like, why do we got to do politics, man? So because if I voted for Trump now, Adam's gonna think I'm a horrible person. But I'm not a horrible person, Adam. I appreciate you and I appreciate your comments. I'm not horrible, and I agree with you. Government is the problem, and I'm trying to help wake up people, brother. I really am trying to do that. This is a comment from Don't Move to Texas. This is my buddy. He's saying they're approving FHA and conventional over 50% insanity. So, well, that's not true with conventional. First of all, they're exceeding qualified mortgage guidelines. Okay. Every single loan program is. Okay. So that's the first problem. So there is no Dodd-Frank Wall Street Reform Act. Okay. It's a bunch of nonsense. Conventional, you can go to 50% with compensating factors. FHA, you could almost everyone that has a score above, say, 680, even if they don't have a down payment, FHA, you can go to 56.99 on your back end ratio for debt to income. It's nuts. So, and that's based on gross income as well. Let's see here. All right, let me go into this video. We've been talking a lot on this segment. We're going to go into our third video, which is going to be how the rate cut cycle might be over for this year. So all the people that purchased a home expecting to refinance, that was a huge mistake. I always will say this: do not be buying houses based on your belief that you're going to refinance later, right? You don't want to refinance later. I have a whole story I could tell you guys why refinance is so expensive, and refinancing traps most Americans into being debt slaves to the bank just to get like $15,000. So they spend the $15,000 and now they start their whole loan over again. Their payments $300 higher. I mean, refinancing is very dangerous. But let's go into the video. Rates cuts may be completely off the table. And if you guys can let me know that my audio is okay, and I'd appreciate it. I'm going to mute us right now.
Next guest says you may want to stop trying to guess what's going to happen and just get on board with some stocks that he likes, regardless of what happens. Let's talk about it all with Bryant Van Cronkite. He is Senior Equity Portfolio Manager at Allspring Global Investments. We've got your picks, but, you know, maybe comment, Brian, on what you heard Loretta Mester just said. I love the fact she came in. She was brutally honest, and I appreciated the fact that she kind of said, listen, the Fed maybe whiffed a little bit.
Yeah, I think she's absolutely right. I think number one, right now, I think the Fed can just be on hold. They don't need to do anything. They accomplished their mission out of the gate. And today you see unemployment at very low numbers and stable. Inflation is moving modestly higher, but not in an alarming way. And so I think the Fed's cutting cycle is over unless something breaks. And if something breaks, it's usually very bad for investors in the short term. But the Fed will then step back in and do their job at that point in time. But if you're on the Fed board right now, why get involved? Just step back and say, I don't know what's going to happen in regards to tariffs, immigration policies. I'm just going to step back, not cause any trouble, and just be here to pick up the pieces if something does break in the future.
As a fund manager, your job is to take the current and future economic situation, plug that into your models, then come up with some stocks. So you like, let's say a Canadian Pacific, for example. Does it matter what the Federal Reserve does vis-a-vis your investment in a Canadian/American railroad?
Well, the Federal Reserve always matters, right? They always have the ability to drive markets and the economy. But in a moment in time like we have today, where I think they're going to be less involved than they were over the past 12 to 24 months, I think you want to own businesses that have financial freedom. Financial freedom is something we measure through the company's balance sheets, and it's the ability for them to play offense with their capital allocation decisions. For example, Canadian Pacific, the railway, made a big acquisition of Kansas City Southern a few years ago. That acquisition allows them to be the only railway that controls transnational from Mexico through the U.S. to Canada, which is a really important rail to have. Now, what's great there is that the benefits of that are still way ahead of us. No matter what happens with the economy, we're going to see volume increase. We're going to see them gain length of haul. We're going to see margins expand through that acquisition. And that's going to be really good for us as investors. Now, we might get tailwinds or headwinds, but they're on their own doing a great job.
I forgot to take the mute off. Okay, couple things. Let me put this on pause. I'm not going to go into the Fannie Mae. I want to go into Fannie Mae, but we just lost time. I want to go into some of these questions. And I want to encourage some of the people that, I got a new super chat here. First of all, thank you, Laurel. Appreciate you joining the channel. I can't wait for the school to roll out. I think that you'll love that. Okay, Nikki, thank you, Nikki. Why eliminate property taxes for Blackstone? And you want Texas families to pay their bill via inflation. Texas will be all institutional investors. So I was actually going to pull your comment up, Nikki. Where was it? I started right here. This one. This is what I'm going to pull up because I appreciate you, Nikki, and I wanted to clear this up. And I love you, and I thank you for being here. I don't want anyone to attack anyone. We're on the same team. I'm with you, Nikki. You're not alone. But let me explain this real quick, okay? We're not, and I'll let you take this over as well, Mitch. But here's what I want people to understand, Nikki. Okay. Before you start, making accusations like it's just going to help Blackstone, institutional investors, first, what I need you to understand is that they're committing fraud against the American people. Okay, that's step one. So you have to understand, Nikki. Whatever happens afterwards, we'll talk about that. We'll figure out solutions. I love you. I want you to do well, Nikki. But we have to first acknowledge that they're committing a crime against the American people. And because they're committing a crime and a fraud against the American people, we have to stop it. We have to have the ability to live the American dream and own our properties. We cannot allow, Nikki, the government or any institution or investors to come take our property once it's paid off, right? I get if there's a loan. So I understand your point as well. I understand that perfectly. So I think that if we have a combination of things, Nikki, and we can get institutional investors to stop investing in SFRs and SFHs, single-family residences, single-family homes, I think that would also go a long way. But also understand what you're saying, that it's one of their biggest expenses. If one of their biggest expenses goes away, then naturally they should be able to drop rent. But I understand your point, Nikki, and I wanted to acknowledge that. She's worried that they're just going to stay greedy, Mitch, and they're not going to lower the rent at all. They're just going to, instead of lowering the rent, they're going to absorb the profit. Are you concerned with something like that happening, Mitch, if we eliminate property taxes? Or do you feel like institutional investors and landlords would drop the rent along with the drop of property taxes?
They would have no choice but to drop the rent along with the property taxes, because it really does come down to what mom and pop can afford. And then at that point, they would no longer be competitive. In other words, guys like me would slide in right underneath them and crush them, which is what they deserve. Over and above that, I believe that these institutions, i.e. the Blackstones and the BlackRocks, that are investing in these single family residential homes and communities, that they in fact should be prohibited by law from doing so. And the reason why is mathematical. They are skewing the market. There's only so much inventory to go around. And when they start becoming 30% of a community in terms of what they own, they now control that community. And they would say, well, we're doing it because the more we grab, the more efficient we become. The problem is they're doing that on the back of mom and pop, and they're skewing the reality of the marketplace. They are forcing the values to go up and their rate of return in truth to go down. If I went to build a single family residential community, because we've run the math, I would only make about a 6% rate of return in doing so. And I guarantee you, we are a lot more efficient and a lot smarter than any one of these big institutions that are sucking up these properties. So if the net result is only a 6% rate of return, one has to ask, why are they doing it? Well, they're doing it because their investors are going to get hit. They're the man in the middle. And that man in the middle is going to make his fee on 2 and 20, 2% on assets under management and 20% of the alleged profits, if there are any. I suggest to you there won't be any profits. They're in it for the fees. They're going to suck the money out. The investors are going to get screwed. Who are the investors? Mom and pop. Who are the pension holders of the 401ks and the pensions that invest in those type of entities, i.e. BlackRock, Blackstone? Mom and pop.
It's really well said. So in other words, Nikki, because the competition, because if someone like Mitch Wexler builds an apartment complex because he understands the math, he's going to low cut everyone else if they're not willing to drop their rent because of operating costs. Nikki, I thought you had a great question. Thank you. Keep asking your questions. I think they're very important, and thank you for doing that. And they also, Nikki, you don't have to, thank you for the super chat. Obviously, it's a hard life being a full-time YouTuber. Nikki's saying, and I want to answer this, Mitch, only eliminating property taxes for owner occupied. And I've seen a lot of people talk about like, oh, this is great, but not for investment properties. Now, here's the thing. If we want rent to go down, right? I don't know another way for rental properties to go down if you're not eliminating property taxes for investment homes as well. If you do it for primary residence, I love it. I'd rather have something than nothing. But I don't know that we would necessarily get rental drops like we need if we didn't do it for both non-owner occupied and primary residence. What are your thoughts there, Mitch?
Yeah, let me take a run at this. So by law, there is no such thing as selective enforcement. You're not allowed to have selective enforcement under law. So what we've said is repeal the real estate tax in favor of a uniform state's sales tax. That means that globally, across the United States, the only tax that would be available would be through the sales tax. In other words, a 2x4 has a cost. That cost would now be a total of 15% tax. What will happen, the math is such that after 3 years, that 15% will actually stabilize out at about 13%. That'll happen. But here's the point. That eliminates anything that is selective enforcement. That eliminates this idea of picking people who are in poor areas and say, well, we're going to help them versus people who are in a richer area. That's wrong. Why? Because you have minorities in different areas. You have to make the playing field even. And what you've had now, if you look at the state of Texas as an example, well, we're going to have a homestead. Okay, so you're going to treat people who have a house different than people who are apartment renters, yet both pay real estate tax. Well, then we're going to have a cap, 10% cap. Then we're going to have this, and then we're going to have that. Well, all this monkeying around is the definition of selective enforcement. You're picking winners and losers. That is a violation of federal law. That, frankly, is a violation of Texas state law. So the point is, the system never worked from the day it was invented because nobody ever thought it through. It may have had originally an honest intent. Let's say that it did for the sake of conversation. The truth is, every time they go to monkey with it, well, we're going to create the Robin Hood. We're going to create the home extension. The monkeying around is the proof that the system doesn't work. And the net result of what the system has truly done, which is clearly evident now, is that every dollar that you pay in real estate tax gets levered 20 to 1 and stuck over in the school districts and their bonds. Their bonds aren't worth anything. The school districts don't have any assets. The school districts, by definition, have committed accounting fraud underneath the auspices of the state comptroller. It's clear. We've got the map. We're showing exactly what's been done. Well, how can anybody possibly say that the system is legitimate when in fact it's being run by accounting fraud? Get rid of the fraud and you will watch how fast these values come down. They have to. The inflation will go away by definition. The fraud is the inflation. It is these entities, i.e. the state comptroller that oversees the school districts. It's the school districts that own the central appraisal districts. And every stitch of this chain is criminal. Why? Because it's a violation of the 16th Amendment to the U.S. Constitution. Market value is an unrealized gain. And the whole thing falls down from that one simple fact. Then you add the fraud on top of it, and the fraud falls at the feet of the fraudsters. And those people belong in jail.
I want to ask the viewers a specific question. If you guys are still listening to this, please comment below. It's a specific question. Don't you think Mitch should be a teacher? Would you guys listen to this man if we made a school and he was an instructor? I mean, seriously. Oh, wait, over here. It's the reverse. Don't you think Mitch should be a teacher? Comment below. Do you guys learn from Mitch? Maybe he's not a nice guy. Maybe he is. I don't know. Okay, first of all, Mitch, hold on a second. We got so many comments, and I got to bring some of these comments up. They're too good not to, but we're running out of time. So work with me here. Okay, so we handled Nikki. Thank you, Nikki. Nikki, super chat. Dragon, thank you so much. Dragon gifted 20 real estate mindset memberships. Thank you, Dragon, for the support. Really appreciate you. Okay, so here, and then let's be fast, Mitch. These are just so good. There's just real people asking real questions. You know, it's so important to understand what people want to know. So questions: replacing property taxes with sales taxes. Will sales tax be applied to home and auto sales, Mitch?
Not on homes. Probably on autos, because auto is a part, but not on homes, not on real estate. Real estate is no longer taxed because it's the asset under your feet. And the benefit of doing this in 30 years from now, or 25 years from now, or 15 years from now, depending on what your amortization schedule is, you will own that asset under your feet and nobody can take it from you. Like this gentleman in Denver who has the business, he owns the building, but there is no business occupying it. And he doesn't have any money to pay the real estate tax because there's no business occupying it. His business is closed. Well, you're in the same position. Every single homeowner is in the exact same position that, okay, if I pay it off, I need to own that asset because that is what it is I will retire from. If that asset in 20 years from now is worth $400,000, I have some money to retire from. What they have done under the current system is they have stripped that equity out of your house and flipped it into debt. And the debt is at the school district level to the tune of, in certain areas like Claiborne, Texas, or Godley, Texas in particular, $250,000 per household. It cannot be paid off. There's no math on this planet that's going to get that paid off. Not today and not in 30 years from now.
You know, but at least they got those stadiums. You know what I mean? Those freaking $500,000 or $500 million stadiums that no one uses. What the hell? How are they getting away with those stadiums? Real quick, Mitch, I didn't mean to cut you off, but a little bit I did, but passively and respectfully. All right. So the answer to the question, it's like, all right, should Mitch teach? Look at some of the responses that we got a yes, we got a yes, we got a yes. Kim, I expect you to be there. Lady, I expect you to be there. Professor Mitch. Yes, look at this. Listen to this. Poll time. Absolutely. Okay. Poof, Mitch, we need you. We need you, Mitch, for president. Oh, I've been trying to get Mitch to run. He's not running. He's like, Travis, I'm not stupid. I don't want to be a politician. All right. Couple more things here, Mitch. Here's a good comment right here from the Panda Smuggler. Don't be smuggling pandas, bro. Don't be smuggling pandas. I don't think people realize how regressive property taxes are. I think they're starting to realize it from listening to what we're talking about. Let's go and, okay, we talked about this. Yeah, let's do this here. I got a little bit lost here. Okay, this is from Buffalo Blanco. We got a housing market question here. Is it worth it to buy a home in Dallas-Fort Worth with crazy incentives and new cons paying cash, but the community is recent, much empty, 500K cash, or should wait? Buffalo, my answer is going to be generally the same with every single person. You never told me about whether or not you're getting a great deal. You've never, this is what I want to hear, Buffalo. I want to hear you tell me why it's a great deal. I want to hear you tell me how wedge works. I want to hear you tell me how cash flow works. I want to hear you tell me that you've been doing market analysis. And I have a new class on that. I'll be teaching the class. But I don't know if that $580,000 house is worth $1 million. Maybe, but if it's worth 400,000, no, even with incentives, you shouldn't do that. So the math matters, but I will say this, overall, it's a freaking horrible time. One of the worst times to buy in the history of the United States. So overall, it's toxic. I also want to warn you on new communities, especially what happened during the global financial crisis is a lot of those new home communities that weren't completely sold out and were empty. They were like foreclosure towns. So you want to be careful of that because they couldn't even fund the HOA. There wasn't enough people living there. So the properties turned to mush. So you don't want to blindly just purchase a house in an empty new subdivision community. Plus, it's extremely hard to sell your house if there's a builder in your community that's selling new houses with crazy incentives. So if you buy in a new community, you're essentially locked down. You probably can't sell your house because, again, you're now competing with the builder. So I don't know that yet. We have a video on this, Jeremy Bagot. So if we go to the home value fraud and you go to appraisal discrimination, we actually have that in there. We have a guy that is all over that, actually. Let's see here. Oh, we do the media blitz for owner occupied. Okay, we talked about that. Okay, we talked about that. So let's see. There's some other good stuff here. And so let's see here. Powers. I think that's maybe almost everything. Thank you. I got a compliment. I will hold on to that compliment, Mitch. It's Valentine's Day. I'm in my 40s, brother. I need everything. You know, I'm tired. It was hard to wake up today. I've been working like a madman. Let's see what else we got here. Great answer, Mitch. A lot of people appreciate it. Let's see here. I think that's gonna do it, guys. Let's see. I'm scrolling down. There's still a lot more comments. We just got a super chat here. Proof Mitch Fund. I appreciate you, Dragon. This is to you, Mitch. Appreciate that. Mitch, anything else here? Dragon, definitely appreciate you. We're gonna get him out of here, Mitch. I think that's pretty much everything. Obviously, there's a ton of stuff I missed. We're sorry, guys. We're gonna try to do these live videos on Fridays. So if you want live Q&As and stuff like this, look for that to happen Friday morning until we have our school set up. But Mitch, anything you want to say before we get the viewers out of here?
Yeah, I think what we've seen by virtue of these CNBC clips, and it hits people all the time. Well, this bank is offering this incentive, and this real estate developer, single family housing developer is offering this incentive. It's best not to fall prey to the incentives. If I had a wish right now here is that mom and pop would not fall prey to the incentives and would simply sit down with a spreadsheet and say, here's my income, here's my expenses, 28% debt to income. This is the target price that I can afford, and stick to the math, because the incentives will just get you into trouble. You've got to assume safely that this market will devalue by at least 30%. So why would you buy something at today's price, knowing full well that the problems are in the economy that we've laid out? And at virtually every video that Travis has done, below those videos are a list of documents with the math in them. We've been unquestionably forthcoming in everything we produce. We're hiding nothing from anybody, to the point, we've been rather verbose about going after individuals, because if they're criminals, they need to be called out. So we hide nothing with the idea of saying, here, mom and pop, please pay attention to this so you don't get into trouble. You've got to look at your asset, not as something you're going to own for the next 3 years, but something that you would retire with in the next 20 or 30 years. And you've got to protect that asset. And if your current asset is cash in the bank and you exchange that cash in the bank for a value that isn't there, well, what did you do? Price is what you paid, value is what you received. The value that you received is 34% or 40% less than the price you paid. Therefore, your liability is now greater than your asset, and that's the definition of bankruptcy. So that's the reason why we're hammering to try and make these points crystal clear.
Well, I definitely appreciate you, Mitch. Now, to everyone that is still watching, once again, you guys, happy Valentine's to you as well, Orange Crush. Happy Valentine's Day. Hope you guys have a great Friday. Hope you guys have a great weekend. We will see you guys on Sunday, I think. And we'll start working really hard come Monday again. No videos tomorrow. And other than that, guys, we're going to get out of here. Really appreciate you guys. Happy Valentine's Day again. Got a lot of just really positive comments here. A lot of positive comments. Man, we can't do this without you. You guys keep us going. We definitely appreciate it. We got a lot of great things coming. We are going to do everything that we can. And I want you guys to pay attention to what I'm saying here. We're going to do everything that we can. Well, number one, to afford to be able to continue to fight this fight, but we're going to do everything that we can to continue to unite us. There's been many times that I've wanted to quit, guys, especially when I got back from, West North Carolina and Tennessee. I mean, that hurt me, my soul, seeing what happened out there. But we're not going to give up. We don't take anything lying. I just needed a quick minute to rebound. And you guys, we're going to go full steam ahead, and we're going to do everything we can. You have our word on that, Mitch and I's word on that, to end property taxes. I know there's a lot of uncertainty here. People are like, oh, you clueless, this and that, but it doesn't matter. They're committing fraud. They're committing fraud. They're criminals. We need to stop it. That's the point we're trying to make. What happens after that, we can come together as a society, although the politicians will probably mess it up, and figure it out. But we got to stop the crimes from happening. And I hope you guys see that. That is going to be a huge part of what we do next. On top of that, a huge part of the school is going to be teaching you guys how to navigate this extremely toxic housing market. And I'm going to do the best I can to get you guys out of your emotion. Even though I'm an emotional guy, I'm also a math guy. So I'm going to try to get all of us, including me, out of our emotion and into math. You guys, I'm looking every single day in the housing market. It's just incredibly hard. I am not going to settle. I'm going to wait until I find wedge cash flow on a home that I love. And in the meantime, I'm going to love my life. I've redefined it. Home is where the heart is. I absolutely love you guys. Mitch, stick around, man. But I'm going to get him out of here. And guys, if you're just out there living your life, investing in real estate, whatever it is, you guys already know, we wish you luck and we hope you win.